Good morning. Good morning, everyone. Good to see a few of you guys jumping on right now. Morning, Alison. Morning, Graham. Evie, Marat, Jignesh, Adrian, Aaron. Good to see all you guys. Hey, welcome to another Wealth Coffee Chat. Tuesday, terrific Tuesday. Good morning, Sharon. Good morning, Alexis. Great to see you guys jumping on. Linda, welcome along. Fabulous to have you here. All up and running right now, which is great. Do quick intros while we're letting people get themselves sorted. Jason Witten's my name. Most of you know that already, but if you don't, or if you're new, if you're wandering by, you found us on purpose or accidentally or whatever it is, welcome. Welcome to our Wealth Coffee Chat, where we hang out, a few mad, keen property investors, and we talk about the idea of investing in property, creating wealth, creating cash flow, creating some valuable asset for you and your family and your goals and dreams into the future. And so welcome along. We've got a couple of sayings around here. Buy well, never sell. I'm a big believer of owning a piece of real estate for as long as you can, if not forever. And, if you look at real estate and you're not prepared to own that thing for a long time, then don't buy it, as far as I'm concerned. If you're buying and selling, that's a different thing. I call that a business. I call that trading. And that's not what we talk about here. We talk about buy well, never sell. This thing's a marathon, not a sprint. If you own property for 15, 20, 25, 30 years, then you're going to be very happy. And especially if you buy and own really good, high quality property. That's the idea. That's the gig we're going to talk about. I'm sure there's other ways to do things. I'm not that naive. But this is the way we do it around here, and it seems to work extremely well. So there you go. Hey, Warren. Thanks, mate. You can, these days with a bit of technology, you can tune up. It looks like I've been to the beach. But thanks for the shout out, mate. Hey, listen, today I wanted to talk about leverage. Now, leverage for all of us, unless you're, sitting on a pile of cash, you've got a lot of cash under the bed, leverage is going to be absolutely vital for you as a property investor to get your mojo on, to get your momentum when it comes to building your property portfolio. We're going to talk about that today, some of the pros and cons of leverage, but a few of the sort of the game plan around leverage across the different stages of building your property portfolio. And the idea, there was a bit of a shout out yesterday. Someone said, hey, could you explain equity arbitrage a little bit more? And I'm going to talk about equity arbitrage as well a little bit at the end of this. But let's talk about leverage. Let's talk about the idea of taking two things that you might have and turning them into something else. What are those two things? We all start with, ladies and gents, put it in the chat for me. There are two things that we all start with. Hey, good morning, Laura. We all start with as property investors when it comes to, getting this gig going. Let's try that one. There are two things that we start with and we turn them in to a property portfolio, okay? For most of us in the world of investing, 99% of us start out at this point. Number one thing you need as a property investor is this, which is, yes, Alison, good. You need a deposit. I'm going to put a deposit as the second one, but you need a deposit. And what else do you need? And Sharon said it there, you need a deposit and an income. A job, an income, something steady, something the lenders, the banks and the institutions of the world who are happy to lend you money need to know that you can afford it. So you need an income and you need a deposit. Yep, absolutely. Rebecca, 100%. You can use equity, home equity, but before you had a home, before the first property you ever purchased and you got some equity assistance per se, let's say, when it comes to you building your property portfolio. You needed a deposit and you needed an income. We all start there, which is fantastic. And we now have decided we're going to deploy that into the world and get the most out of what we have when it comes to our property investing, our ownership, our acceleration into the future. So let's talk about what that might look like, some rules of engagement when it comes to you and building your property portfolio as we go through this this thing called a marathon, not a sprint, all right? So everyone knows the 3 stages. If you don't know the 3 stages, hey Roz, good to see you all the way from the sunny coast. It's not so sunny today here in the Gold Coast. And morning, Kevin, all the way from the States, if I remember correctly, Kevin. Good to see you. Thanks for joining. And Rodney, mate, how you doing? Good morning. So the acquisition stage, the consolidation stage, and the lifestyle stage, okay? When we talk about buying and building our property portfolio across these 3 stages, and these stages might take us, well, they will take us to do this very well, anywhere from 15 to 30 years. Now, it depends on where you are right now on that journey. Someone's all the way from Cairns. It's been bucketing down for weeks, hasn't it? All on the East Coast. Welcome all the way from wet Cairns, folks. Good to see you. Good to see you. Hey, we're talking about this. We're talking about what is it going to take? Leverage. The idea that you can take an income, a deposit, and turn it into much more in value than the deposit you put down, which is fantastic. That's what leverage is good for. So when we're talking leverage here, folks, when we're talking the ability to borrow money at a certain percentage, let's talk about what that looks like. Give me a little bit of an idea in the chat right now. When you're starting out and you're buying your first home, this is kind of like a, you get a one-shot wonder at this sort of first homey stuff. But tell me, the loan-to-value ratio, the ability of the ratio of percentage of deposit to the rest of the loan, what can you borrow to when it comes to your first home? Chuck that one in the chat for me as we go. So let's do this, and we can talk about, as we roll, how this comes together, because you can see this progress as we talk about leverage this morning and what we do about it as our leverage becomes, let's say, less attractive. All right, so chuck that in the chat for me now. Let's say your first home, you're a first home buyer and then investor, okay? As we go along, Tanya's saying 90-10. Yeah, that's certainly doable. Tanya, in here, you can borrow up to 95% as a first home buyer. Lots of first home buyers with their first properties can borrow up to 95%. Whether you do or not, it's usually one go at it with 95%, and if you've got a good enough income. Investment, for many of us, we want to be able to, if possible, to make our money go further, be borrowing at a 90% loan-to-value ratio, okay? What does that mean? How does that work? Very basic terms. You guys know this already. If you had a $50,000 deposit, you can turn that into a $500,000 property. 50K turned into $500,000. 100,000K, 100,000K, 100K, $100,000 turned into $1 million worth of real estate. $1 million worth of real estate, okay? So for me, for you, as we look at leverage when it comes to these stages of investing, it's important to understand the opportunity and maybe there's some of the pros and cons of that, which we'll talk about in a minute. So in the beginning, in the early stages, your PPR, your home, your principal place of residence, plus up to, on average, 3 to 4 investment properties. You'll be able to use 90% lending and get 90 to 95% borrowing when it comes to your leverage. For most people, if you've got a higher income, or if you've got a lower income, or whatever it might be, this is, for most of you listening in, this is where we sit when it comes to our leverage action. When we're moving along and we've got multiple properties now, when we sort of see the ability for us to continue investing along, if you have a look, you bought your property there, you bought another investment, you've got another investment, and you've got another investment. Let's say you're building your property portfolio. What starts to happen with the lenders is they start to, your income, basically, your job starts to run out of steam, okay? And over here in this consolidation phase, what starts to happen is the lenders will want to lend you less money and you have to put in more deposit as you're going forward. Now, that might not be a big deal. That might not be an issue. And for most of us, that's fine. Once you've got 4 or 5 properties, if you can continue to get access to a bit more lending at 80% LVR, happy days. That's fine. No big deal. Not a problem whatsoever. Okay? So usually what happens is, let's say it starts out at 90, goes along like this, starts to decline, and then over in this section here, which is the problem with leverage, when you're a bit older, when you don't have as much income, let's say you're semi-retired, etc., etc. Now, the problem is, folks, listen, if you're 55, 60, the lenders are looking at you going, yeah, we're not going to lend them the money, or we're not going to lend it for that long, or we're not going to give them as good a loan-to-value ratio. So that becomes problematic. That becomes an issue for some of us if, what's happening. Because what happens is this, team, is over here, as we're traveling along, your values go up. Let's say this is where your property portfolio grew, and you have quite a gap between what you can get access to when it comes to your wealth. You start out over here with a couple of $1 million worth of real estate. Over here now, this real estate's worth $4 million, and you've got a loan of $2 million down here, and there's $2 million in the middle, in the gap here, $2 million worth of equity. And I see this all the time. I call these people the rich poor people. They've got all this equity they can't get access to create some income or some extra wealth, okay? So here's the pros and cons of leverage. You get started, you get cracking early, that's fantastic. It allows you to expand it. But later on, there's some challenges here when it comes to leverage. So I hope that's making sense as we're going along. Leverage, absolutely important. Let's have a bit of a look at the pros and cons, or some of the pros and cons that are about this idea of leverage. When we're using money, we're using our money, our job, our ability to borrow our assets to get more money to buy some more assets, which is pretty important for us to do. So some of the pros and cons of leverage, using loans to accelerate you forward. Number one pro is it helps you expand your wealth, okay? It helps you expand your wealth. It takes your $100,000 and gets you exposure. It expands. You get coverage. You take $100,000 and you open up the possibilities to have market exposure to $1 million worth of asset, Okay, we're going to talk about that in a second. It expands your wealth. It helps you expand your wealth. The con of that, the challenge of that, which many people can come unstuck with, is it comes with a cost, right? It's not free. You guys know this. You guys know this. So you need to manage your cash flow. Okay? And right now we're talking, everyone's keenly watching. What's everyone watching right now and sort of, wondering, if I've got a lot of leverage, if I've expanded my wealth, but I have exposure in the marketplace, what's my number one expense in my property portfolio, folks? Put that in the chat for me. What's my number one expense that I've got to keep an eye on that can affect my cash flow? Boom, interest rates, Alison. So what is the interest rates, right? Interest rates, okay? And sometimes if we're not prepared and we don't have our buffers in place, all of you guys will have buffers in place, you should. If you don't have buffers in place, you can get exposure that can cause problems. That can be a con, that can be an issue for you when it comes to this sort of stuff. Now, the next pro, and a con, it can be a problem as well, is you can get a far better cash on cash return. Some people call this an internal rate of return, etc., etc. Okay? And what does that mean, cash on cash return? So if you have $100,000 in cash, okay, and let's just say this, let's just do this, $100,000 in cash, 100K in cash, and you put that into the stock market, okay? Just 100K neat straight into the stock market, and you get a 10% return on that. Well, you won't get a 10% return, but let's just say you get a 10% return. 10% return equals 10K, okay? Now, $10,000, that's pretty good. If you get a 10% return, you've got to pay some taxes, whatever. If you're doing the right thing, you probably won't when it comes to managing and minimizing your taxes, but let's have a look. So, 100K into stock, or you get 100K, you now turn that into $1 million worth of real estate. Okay, so now you've gone from 100 to a million. That now, let's say that real estate grows in value 5%. Let's say you get a 5% rental return, and let's say you get 1% back in tax deductions, right? Your result here, the combined result of that return when it comes to you and your value, that grew $50,000, 50K. You've got $50,000 worth of income, and you got $10,000 back in. You got $10,000 back in tax deductions. When we look at the cash against cash return, team. See this 100K? Now, I'm not talking about expenses right now. I'm just talking straight cash and cash return. The expenses are something you manage. What's the percentage? What is the percentage of cash on cash return, right? And it's over 100% gross, okay? Gross return. Everyone follow along? Does that make sense? Time frame, 10-year, call it 12 months, whatever it might be. I'm just using this as an example of understanding leverage, what internal leverage does. Internal leverage does, it gives you a far better return. It makes your money work harder, okay? Makes your money work harder, okay? Everyone cool with that? Now, on the flip side, that exposure also, it can make the losses bigger. Yeah, everyone understand what I'm saying about the losses can be bigger. So let's say that went down 10%. So let's say the stock went down 10%. Well, you'd lose $10,000. You lost 10K, okay? But over here, if that went down 10%, on paper, you might lose 50K. Everyone cool with that? Okay? Now, for me and you, we know in this space, buy well, never sell, okay? We're going to own this thing for the next 15 or 20 years. These fluctuations in value are very normal in real estate, okay, as you go. Away we go. All right, who's that on there? You need to remember, not everyone can waltz out and purchase $1 million property as their borrowing capacity doesn't allow it. Yeah, absolutely, for sure. The challenge is for many of us, our income holds us back, okay? The idea that over time, you start with whatever you can buy. Whoever that, give us a shout out in the chat, whoever's saying that comment. You start with what you can purchase and you build from there. I've got many, like more clients than I can possibly count that have got medium incomes and own multi-million-dollar property portfolios. And that just takes time. It takes a bit of patience, it takes a bit of focus. But yeah, your income is the number one thing that holds us back when it comes to borrowing, folks, as you go. All right, another pro, another con, okay? A pro about leverage, like I said before, when you get exposure, wider exposure, when a small amount of growth happens, it increases your wealth faster. Okay, increases your wealth faster. Okay, so when $1 million worth of real estate goes up, at 10%, your wealth increased by $100,000. That's what happens. If you only had $500,000 worth of real estate because you were borrowing at 80%, okay, you can use that money to get more, folks. Okay, so what happens often is there's some misunderstanding of leverage when it comes to borrowing. Someone will say, "Oh, you should just borrow at 80% because it's better and easier, safer, whatever." But if you could borrow at 90% and your income allowed, you could go from $500,000 to $1 million worth of real estate, okay, as we go along. So it can increase your wealth faster as you go, but also a con is your wealth can get stuck. Okay, your wealth can get stuck, team, okay? Because let's say your value has grown and this is where your wealth gets stuck, okay? What can I do with it now? I've got a lot of equity, and this is what's happened in recent times, this last couple of years. A lot of people have got quite a lot of equity and their wealth is stuck in these properties. They don't want to sell those properties, which I'm with you, I wouldn't sell. But now how do I create income and how do I create value and wealth into the future on that? So there you go. All right. Hopefully that made sense today. Give us a shout out in the chat. Yeah, I mean, Alison's right. Depends on where you are and what you're doing, team. Don't take one opinion about borrowing as fact, okay? There are 113 lenders, people who will lend money in Australia to investors and homeowners, and there's lots of different ways to skin the cat and get your leverage going. That's why you got to speak to a coach or a mentor or an expert when it comes to this stuff. Certainly don't take the Bank Johnny's the Bank Johnny's word for it. All right, hopefully that made sense today, team. Leverage is vital vital, vital. If you get it wrong, it can bite you on the behind. If you get it right, it'll accelerate you forward. The biggest challenge for most people once you've got this part underway is your wealth getting stuck. I don't have time to do the equity arbitrage stuff today, but whoever asked me that, I thought I'd get onto it today, but I didn't. But let's say in the next couple of days, I'll do a bit of a refresher on equity arbitrage, team, and what that might look like. All right, team, that's it. Couple of minutes over. Great to have you guys on the Wealth Coffee Chat today. Join me again tomorrow, around about 8:05 to 8:10. I might kick off a little bit earlier, 8:05-ish, 8:08, 8:10, something like that when it comes to our live streams. All right, that's it. Great to see you guys. Thanks for joining me, team. Bye-bye. Have a great day. See you tomorrow.